Well, let's look at the week that was and the week that will be in U.S. equity markets. During the week, I got a number of questions. Can you talk about this? Can you talk about that? So I'll incorporate some new things into the weekly update, but I can't cover everything. Otherwise, this would end up being a 10-hour video, and it would take me all week to do. So I'll try to incorporate as much as I can. The other suggestion I had was, could you please start with a list of the things you're going to talk about along with the times in the video, so we could just hop right to that point instead of trying to guess. And I thought, that's a fair statement. I can do that. So here is our list of what we're going to cover this week. We always start with the rates because the rates really set the price of risk for everything. So we'll look at the par rate. We're going to review the FOMC statement and the statement regarding balance sheet runoff. Then we'll move to real yields and break-evens. Big moves here that have implications for the US dollar, for equity, and for REITs. So we'll talk about what these moves mean specifically for those three categories. We'll have a look at mortgage rates and mortgage applications again. I think it's always worth keeping our eye on this because housing is considered to be in a bubble. And if we think about inflation, there's price inflation and asset inflation. And the one category that has seen wicked asset inflation in the last several years, the last 4 or 5 years, is housing. And we're going to look at a Gallup poll that may give us some idea of what demand is looking like in the housing market. Our deep dive of the week is jobs. You know that every week we do this. I try to highlight one economic report or one source of information that the retail investor can go to, because you're never going to have the advantage that the institutional investors have when it comes to information. You're simply not going to pay thousands and thousands of dollars for those types of subscriptions. So we want to try to get as much as we want for free. So we'll look at jobs. That's our deep dive of the week. From that, we will look at the idea of onshoring, this idea of bringing supply channels back to the U.S. to create supply channel resiliency instead of efficiency. That's going to be questionable, extremely questionable. And if you're wondering, on Wednesday, we rallied on Wednesday and we gave it all back on Thursday. Why? There was evidence that we have looming stagflation happening in the U.S. We're already seeing that in Europe, and it looks like this indicator was a big hint that, hey, I think you're going to get it here. We'll look at commodities in general. This will give us some idea of, or at least a small little peek ahead into the CPI report that is going to happen this week, and a deeper look at WTI, and I will show you a bull spread trade on the USO, and we'll look at what is supportive of prices and the big threat to the price of oil. Earnings, we always look at earnings, look at forward multiples again. And I'm going to show you a bear spread on SPY using, instead of a price, using like 400 to 380, we're going to use a forward multiple, a 17 forward multiple down to a 16 forward multiple bear spread. And we're going to look at 5 and 10-year growth trend lines. The thinking is, well, asset prices are inflated because the Fed inflated their balance sheet. But if we say, okay, well, let's forget about that. In the absence of all of that, what would the level of the S&P be at if it just stayed at, let's say, 8% growth over the last 10 years or 10% growth over the last 10 years? And we'll look at where it would have ended up instead with all of that. Some of these may surprise you. Look at the economic calendar for May 9th to the 13th, the week coming off. The big one is CPI. Earnings have pretty much died down. There are a few majors reporting next week, 5 or 6, and nothing that's going to move the dial at this point. And then some other notes. Barron's ran a big spread, the future of transportation. And I'm going to introduce you to somebody named Pete. Let's go. Okay, let's have a look at our par rates. Big moves at the long end of the curve, the 5s to the 30s. Big moves there. Not a lot going on at the short end of the curve all the way up to 3. These, given the volatility we've had, they tend to be very small moves. I tend to look at them as unchanged. This is the big one with the 10-year being really interesting, breaking 3. There was a lot of thought that the 10-year yield would be capped at around 3. It is the real rates that have the really interesting story this week. For slope, all of them have increased. The 2s to the 10s and the 2 to the 20 are all steeper. So we had a curve steepening over the course of the week. All of them are up. And of course, you have a steeper curve, you're going to have a little bit more curvature there as well. Let's have a look at the FOMC statement. They went with 50 basis points. And in the press conference, Powell took 75 completely off the table, saying we're not even considering 75. So that was part of the rally on Wednesday afternoon, is that, oh, okay, you're not going to consider 75. 50 is the way to go. You're going to be very measured in this. This is not bad. Balance sheet runoff, I had last week said that we could expect to see $960 billion over the course of the next year. For the next 3 months, treasuries will be capped at $30 billion, mortgage-backed securities at 17.5. Thereafter, treasuries will increase to $60 billion, mortgage-backed securities to 35. So over the course of the year, it's $997.5 billion, basically $1 trillion running off the balance sheet. However, when it comes to the mortgage-backed securities, we're not quite sure whether it will hit the 367 because in the press conference he did mention that there may not be enough rolling off each month to hit the cap. This is the allowing principal to roll off, and mortgage-backed securities, the principal repayment also includes prepayments, mortgages being paid off early. In interest rate environments that are dropping, you do get faster repayments of principal. The speed of the MBS speeds up, but in rising rates it slows down. So that's what he's getting at here, is that we may not see the ceiling of 35 hit. So it may not get to the 367, but I think we can expect anywhere from 850 billion to 950 billion running off over the next year. Let's have a close look at the FOMC statement, and then we'll have a look at the statement they made for balance sheet runoff, just so that we get the actual words that they were using. All right, for the Federal Reserve, and as usual, all links that I use are in the description box below. Here on February 5th, if you get to Federal Reserve, you can just click on News and Events, and you'll get this page. And we're looking for the 4th. You have the FOMC statement, and you have plans for reducing the size of the balance sheet. So we'll start with the FOMC statement. And it's not long. It usually is fairly straightforward. Although overall economic activity edged down in the first quarter, household spending and business fixed investment remained strong. And we did see that last week when we looked at the GDP report, that spending and fixed investment remained strong. What took GDP down primarily was a small drop in government spending, huge drop because of imports, and a drawdown of inventories. Job gains have been robust in recent months, and the unemployment rate has declined substantially. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher energy prices, and broader price pressures. We can skip the Ukraine paragraph. We know that it's there. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. With appropriate firming in the stance of monetary policy, the committee expects inflation to return to its 2% objective. So it still is expecting that to happen, and the labor market to remain strong. That's not an or, that's an and. The committee expects inflation to return to its 2% objective and the labor market to remain strong. They don't see that they're going to affect the labor market at all. And at this point, I don't think they want to. You've had incredible asset price inflation, especially with housing. When you look at the price of rents, there's not much you can do with rents. What they would like to see is wage inflation with no other price inflation. If they could, they'd like to get all the other prices down, but keep wage inflation, because it is, leaning towards the wider policy issue of how do we fix income inequality. and wealth inequality. And I've said many, many times that the best way to do that is through wages, not taxes. So they're giving a nod to that. In support of these goals, the committee decided to raise the target range for the federal funds rate to 0.75% to 1%, and anticipates that ongoing increases in the target range will be appropriate. So we're being signaled here. There's more to come. Ongoing increases will be appropriate. In addition, the committee decided to begin reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities on June 1st. So it hasn't started yet. They're going to take the whole month. They're still reinvesting for the month of May. They're not really going to start runoff till June 1st. As described in the plans for reducing the size of the Federal Reserve's balance sheet that were issued in conjunction with this statement, and we're going to read that one. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. And they're getting a big read next week, not their favorite measure of inflation, or I should say their favored measure of inflation, the PCE. We're getting the CPI next week. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessment will take into account a wide range of information, including readings on public health, labor market conditions, inflation pressures, and inflation expectations. This is their big one here, inflation expectations. Interest rate hikes don't do much to tamper down inflation expectations. It is all the Fed speak in between meetings. That's what that's all about. You can work on inflation, and the interest rate will work on inflation. And you can work on expectations by telling people, we are going to clobber this market. We are going to come out with huge rates, and you won't believe what you see. And that starts to tamp down the expectation. However, the policy change doesn't really match the bark. So the bite is far, far lower than the bark, but I expect that to still continue, especially if Wednesday's CPI read is hot. Expect the rhetoric from the Fed to increase, and that the conversation about 75 is now on the table might actually come back. And there we go. We'll click back and look at plans for reducing the size of the Federal Reserve's balance sheet. We all know what this is. The committee intends to reduce the Federal Reserve securities holdings over time in a predictable manner. This is an important word, in a predictable manner. So they will telegraph what they're going to do well in advance of doing it. So there is some concern that they will be selling securities or selling mortgage-backed securities. So mortgage REITs have really taken a big hit over that. If they're going to sell mortgage-backed securities, they're going to telegraph that well in advance. So don't just skip over this word here. In a predictable manner, primarily by adjusting the amounts reinvested of principal payments. Notice it doesn't say by selling. Primarily by adjusting the amounts reinvested of principal payments received from securities held in the SOMA. Beginning on June 1st, principal payments from securities will be reinvested to the extent they exceed the monthly cap. So they're still going to reinvest if the principal maturing exceeds the monthly cap. Treasury securities, the cap is initially set at $30 billion per month, and after 3 months will increase to $60 billion. The decline in holdings of Treasury securities under this monthly cap will include Treasury coupon securities and, to the extent that coupon maturities are less than the monthly cap, Treasury bills. For agency debt and agency mortgage-backed securities, the cap will initially be set at $17.5 billion per month, and after 3 months will increase to $35 billion per month. So we have predictability for the next year. I don't think that they're going to mess around with that. I think at the next meeting, I don't think we're going to get much more information on balance sheet runoff. I think they've set their plan for the year. Over time, the committee intends to maintain securities in the holdings in amounts needed to implement monetary policy efficiently and effectively in its ample reserves regime. We don't know what that amount is, but they're not reducing the balance sheet to zero. They've never really had a zero balance sheet anyways. They're not reducing it to zero. Don't know where they're going. To ensure a smooth transition, the committee intends to slow and then stop the decline in the size of the balance sheet when reserve balances are somewhat above the level of judges to be consistent with ample reserves. So they're not going down to ample reserves, somewhat, not slightly, but somewhat above the level. So they're sort of telegraphing that, yeah, we're reducing the balance sheet, but hey, we're not going to go back to what we think is sufficient. We're going to end up somewhere above, somewhat above sufficient. That's kind of dovish, along with, no, I've taken 75 off the table. We weren't considering it. That explains Wednesday's party. Once balance sheet runoff has ceased, reserve balances will likely to continue to decline for a time, reflecting growth in other Federal Reserve liabilities until the committee judges that reserve balances are at an ample level. We don't know what these levels are. Thereafter, the committee will manage securities holdings as needed to maintain ample reserves over time. So the second part, I think we can ignore for now. This is where our focus is. For the next year, I think this is pretty set. I wouldn't expect at the next couple of meetings that we're going to talk about the balance sheet anymore. I think that's done. So our focus really now is on the data that guides the Fed and judging or predicting what we think the next interest rate will be. Right now, 50 basis points seems to be running the show. That we will get another 50 in June, but we got some data to see before that happens. Have a look at the change in real yields here week over week. Those are big. And when we look at our break-even rates, have a look at the change here. They're all negative, meaning inflation expectations are coming down. Real yields are going up. That combination of these all dropping and these all increasing are very supportive for the U.S. dollar. So I don't know that I would look for U.S. dollar strength anytime soon until these start to change direction. If we start to see real yields dropping back below zero, then yeah, you could see the support in the U.S. dollar fade very quickly. Not only that, as I said last week, where are you going to go? What currency, what other currency, if I say, okay, you can't be in the US dollar, pick another currency that you want to be in right now. Where do you want to put your money? In what markets, assets do you want your currency in? Europe has some problems, and Europe hasn't even begun to raise rates, and they're already seeing signs of stagflation. They haven't begun to raise their rates yet, only because they have much higher sensitivity to energy and food, because the U.S. does have a lot of domestic production of oil, whereas Europe doesn't necessarily have the same thing. So it's a heavy reliance on imports. When I say that the U.S. has domestic production, it's not as if it's any cheaper in the U.S. You still got to pay the same price per barrel, the WTI price per barrel, even though you produce it in the U.S. The difference is the profits stay within the U.S. and the employment that is created as a result of the industry is in the U.S., so those wages are in the U.S. as opposed to it just being a pure wealth transfer out of the country. So it's more supportive of the economy. This combination is also hard for risky assets because you now get a real yield. There are a lot of funds that have a mandate of preserving the purchasing power of their assets and growing their asset base. When you have negative real yields, you can't do either one of those two, which means you can't stay in bonds if you're going to be true to the mandate that you have. So if we think of a continuum, and let's just put a line here, and here's bonds on this side, and we'll put equities on this side. When money gets squeezed out of bonds, it moves into equities, and it moves into equities depending on what the bond investor's mandate was, how conservative they happen to be. If they were really conservative, it may just go into large cap value, but it can find its way into large cap growth, mid cap growth, small cap aggressive growth. And there's your small caps at this end of the spectrum. When you start to get real rates, money starts being pulled this way. It's a magnet for money, and it starts being pulled back into bonds because a lot of funds that had that mandate of I need to preserve the purchasing power of my assets because my liabilities are tied to inflation. And obviously, I want to grow the capital base over time as well. This now offers you the real prospect of getting that done without having to take on the extra risk of being in equities. For cap rates and real rates, especially at the 10-year, are positively correlated. As real rates have dropped over the last 20 years, cap rates have dropped as well. And we know that if we're calculating our property value, it is our net operating income over our cap rate, R minus G. So the lower the cap rate, the higher the property value. And if we can increase our NOI at the rate of inflation, if we can do that, it's questionable whether or not you have enough leases rolling over every year to be able to keep up, especially for office properties that tend to have longer leases. Apartment buildings have held up a lot better because you get about 30% turnover in apartments per year. As your real yields on the 10-year start climbing, your cap rates start climbing. So unless you can grow NOI at a rate fast enough to keep up with the increase in the cap rate, your property prices are going to be under pressure. And if your NOI can't grow at the rate of inflation and your property values are decreasing, it's a double squeeze on REITs, because when they report, many of them, at least in Canada here, they have IFRS reporting. They have investment property. They will mark that property to, market or to model, but they'll have some kind of fair value gain or fair value loss on the value of the REIT, so that does affect the reported earnings per share, while it would not affect other measures like cash flow measures. So this combination here is, again, good for the US dollar, not so great for equities, not so great for REITs. Look at this 30-year mortgage, 5.64. Since we've been watching mortgage rates, that's the highest we've seen, and that's a significant jump over last week, 5.64. Part of that can be explained by the FOMC move. I don't know that mortgage rates were fully reflecting that, but this move from negative yields to real yields is going to show up in rates very quickly. 5.64. This is the week ending May 6th. So next week, mortgage applications are going to be interesting to look at, and same with the week after. Mortgage applications that are reported on Wednesdays are reported for the week before. So this one is for April 29th, up 2.5. The last two reports, last 2 weeks, we saw negative numbers. This is up 2.5. Purchase index up 4.13. And the refi index, there's a surprise, up 0.17. You could basically call that unchanged, but up 0.17. Gallup had a poll out recently with a question for people in general. Do you think that now is a good time or a bad time to buy a house? And they've been asking this since 1978. And you can see throughout the 80s all the way to the housing boom before the subprime mortgage crisis blew up. It just kept increasing. And then it became questionable for a period of time. And then from 2014 onwards, it just started dropping. So the peak was just before the financial crisis. 2014, it hit a post-crisis of 74. The last read was 53. This read is 30. Just drops right down. It's an annual poll that they do. Drops all the way down to 30. Lowest since 1978. No one thinks it's a good time to buy a house. But I don't know how that translates into action. If I ask people, on the way home, is now a good time to buy gas? No, it's not, but I got no choice. Is now a good time to buy food? No, it's not, but I got no choice. So it could be that way with a house. Is now a good time to buy a house? No, it's not, but look at rents. I really have no choice. So you can agree that now is not a good time to buy anything, but sometimes you have no choice. If your car dies and you need another vehicle, is now a good time to buy a car? No, but I have no choice. So I don't know how much we're going to read into this one. We're going to dive deep into the jobs report that happened on Friday. Then we're going to look at some commodity prices. because they've all been rolling over for the last little while, which is positive if we're hoping for a lower CPI. Also, we're going to have a look at the used vehicle value index, and I'll show you a site that tracks that based on wholesale sales of used vehicles. It's rolling over as well. And the last inflation report we read, where we looked for where is inflation happening, we saw that a large part of it, not a large part of it, but used vehicles contributed to inflationary pressure, but that they've been coming down recently. Well, if that continues on, remember the last report I said look at all these negative signs? Well, we might see a lot of negative signs again when we get CPI this week. Let's have a look at Gallup so you know where the site is, and we'll have a look at the used vehicle value index as well. All right, this is Mortgage News Daily. I've shown you this before, but if you're wondering where I get the mortgage rates from, this is the image you saw on the last screen. You can see where it sits right now compared to where it was all the way back to, I think we're going back to 2013, beginning of 2013 here. And there's a lot of good information here. There's a whole bunch of interesting stories that you can read on here. So if you're into this part of the market, this is a nice source to use. Let's go over to Gallup. Record low in US say it's a good time to buy a house. This is timely as well, May 4th, 2022, so it's not as if it's 3 months old. And the highlights here, 30% say it's a good time. 30% say it's a good time. You kind of want to talk to those 30%. Where are you living? What are you thinking of buying? Maybe they're, the ones that have multiple houses that run Airbnbs, or are buying them for rental properties, or own rental properties and are looking at rent saying it's never been a better time. 69% a bad time. 7 in 10 expect home prices to rise in their local area. 7 to 10. Americans believe real estate is the best long-term investment. So, as I said, how do you interpret, it's a bad time. When prices are high, it's a bad time, but when you think about it in terms of, well, I don't really have much of a choice. I can rent, which means I'm just throwing money away, or I can buy a home and at least I'm getting some equity built in my home. And 7 in 10 expect home prices to rise in their local area. So that's still, yeah, sure, it's expensive, but it's only going to be more expensive. So if I buy now, I will have price appreciation. But that is low. But if you want to read the rest of the story, it breaks it down into annual household income, who feels what, and regions, place of resident, home ownership status. And Americans expect housing prices to continue to increase. It goes on and on. So if you're interested in that, the link is in the description box below. And this is the used vehicle value index. Wholesale used vehicle prices, and we can see the chart here. You can enlarge the image, and there's the rollover over here. Again, still elevated, but we are seeing it come back down. Now, we have seen little pullbacks before. This went sideways, little pullback. This seems quite noticeable on the pullback. So keeping our eye on this will be rather interesting, but we are seeing that pullback. The CPI last time did have an indication that used car prices are coming down. So let's see if that trend continues. All right, on Friday, we found out the economy added, and we say 428,000. It's survey-based, so we can say that is the middle of a distribution. There's always variability. About 428,000 with its best guess. Unemployment rate sitting at 3.6%, average hourly earnings up 5.5% year over year. So we're going to dive a little bit deeper into this. We can get a lot more insight when we start looking at certain things. Let's look at by education. Unemployment rate less than high school, 5.4%. If you have high school, it's 3.8%. Some college or an associate's degree, 3.1%. And if you have a BA or higher, 2%. That is not just a coincidence. There is a correlation between your level of employment and whenever you are unemployed, how long you'll be unemployed based on your level of education. However, I think there is a problem brewing in the BA, and that means just a general undergrad. More and more, we're finding that can be outsourced. A lot of that kind of thinking job can be outsourced, where it's the higher degrees that tend to be more domestic employment now. This is a problem. It's always been a problem, but we know that. Somebody who drops out of high school, it doesn't take much to say, look, you don't have much of a life ahead of you. It's going to be a life of struggle. It's going to be a life of economic hardship. This is a bad mistake to make. Now, lots of research shows that if you at least finish high school, you increase your chances dramatically of actually going to college. I think universities are producing way too many graduates with degrees that just simply aren't marketable. And when we look at the cost of university, and I could do a whole video on what's wrong with universities these days, but when we look at the cost of university for 4 years, having been in the university system almost my entire life on both sides of the desk, I can tell you that this 4-year degree is full of courses you don't need. You can bring that down to 2 to 2.5 years easily without any loss of content. And if somebody wants to explore later on to make themselves a more well-rounded thinker, let them do that after. But 4 years, without much difficulty, you can get that down to 3 years. So I think there's a problem brewing here. But what we don't make enough of are mechanics, plumbers, electricians. And I think that's because you can't really outsource that kind of thing. And I think that's a far more important thing to look at. But it's just nice to look at these numbers. We would find nothing surprising with these numbers. Let's look at participation rates. This is interesting. This is as of the last report, and these numbers here are more long-term. Participation rate dropped to 62.2 from 62.4, not where we want to see it go. If we think that wage inflation is going to create a wage price spiral, we need to see the participation rate increase so that there is more supply. Because we'll see down here, unemployed is 5.9 million, openings are 11.5. 16 to 19, participation rate is 36.6% versus a longer term average of 35. So that's up. The 20 to 24s, here's a problem. 70.4% participation rate versus a longer term average of 73. What's going on here? Maybe more and more of that age group is thinking, but I can make money on TikTok, I can make money on YouTube, I can make money on OnlyFans, I can make money with all these gig jobs that I have, driving here and driving there. So maybe they're earning an income, but they're just not counted as being in the labor force by the very nature of what they do. I don't know. But that is 2.6 percentage points lower. If it were added to here, the participation rate would be almost back to where it was pre-pandemic. 25 to 54, not much difference. And this is the age of economic reality. You're old enough at 25 to recognize that life has an economic reality to it. And you have no choice. Maybe you don't like your job, but what choice do you have? Because life has costs and you have to meet those costs. So 25 to 54. And then you have the 55 to 64, long term of 40% down to 38.7. And I think it was the pandemic that, if you were 58 or 59 when it hit, you decided, you know what, why wait? Let's just retire now. I think it accelerated some of the retirement numbers. And that's down 1.3. So if you added these two together, your participation rate would be right back up. Don't think you're going to fix this one. I just don't see that one being fixed. We got to figure out what is going on in here. And if they're seeing, social media and gig work as a viable alternative to employment, how high would wages have to go to bring people back in, right? You have 5.9 million people unemployed. The JOLTS report, this is job openings report. We'll have a look at that in a second. Openings 11.5 million, quits 4.5. That's elevated, over 4 million for how many months running now? And the thinking is you have to feel secure about your chances for employment to quit your job. Usually in recessions, the quits rate goes right down, and the layoffs rate increases. To dive a little bit deeper into this, we think, okay, 428,000, is that it? 428,000 jobs. 6.7 million people were hired. Hires amounted to 6.7 million. Separations were 6.3 million. So the difference between those two is new jobs added. These are incremental jobs that are added. Not new jobs. You could add a whole bunch of new jobs, and there you go, 6.7 million, but a whole bunch of others being displaced. Separations are 6.3. 4.5 million came from quits. Layoffs were 1.4, and retirement was 0.4 million. So, with this idea of onshoring, bringing parts of your supply channel back to the U.S., how are you going to get that done? GM, for example, is building 4 large battery plants, EV battery plants in the U.S., with the first one ready to open later this year. Each one creates 4,000 jobs. So there's 16,000 people you need. Again, and GM's not the only one doing that. Lots of large companies are considering resourcing some of their supply channels. Semiconductor plants, moving from APAC region back into the U.S. How are you going to get that done? Unless you solve it with immigration, how are you going to get that done? Because so it calls into question whether or not you can actually get that kind of thing done. If you're wondering what happened Thursday, this in my mind is the big reason for Thursday, is how did the narrative change so much from Wednesday at close to Thursday at close? In 24 hours, it was when we left Wednesday at 4, it was like this is going to be okay. I think we're going to be okay, to Thursday at 4 of I don't know what I'm going to do. I think I might have to get out altogether. Productivity was down 7.5%. You can't measure, or I shouldn't say you can't measure productivity. Productivity is derived. It's kind of a residual. You can't see it. It's nothing you can measure, like number of jobs or prices or something like that. It's a combination of things. So output down 2.4%, hours worked up 5.5%. So people are working more to make less. Well, that's productivity, right? Getting productivity up is output increases for the same number of workers, or output increases faster than workers increase, or I need fewer workers to produce the same amount or even more. So productivity down 7.5% for the first quarter of 2022. By the way, lowest since 1947. It's this combination: output down, unit labor costs up. That is a hint of stagflation. Output down, costs up. So you have output dropping and you have inflation. That is stagflation, economic growth contraction with inflation. Unit labor costs 11.6. This breaks down into 3.2% increase in hourly compensation combined with the 7.5% drop in productivity. Makes your unit labor costs up 11.6%, highest ever. When we look at where jobs were added, low-income areas, so we can't get too excited about that. Leisure and hospitality, and that is primarily this age group, that age group. This is interesting. Construction, 2K. That is small. That is part and parcel of what's going on in the construction industry right now. Take any builder, when go past any construction site, stop and talk to anybody there and say, do you have problems finding any trades? And they'll all tell you the same thing: yes. I know a guy, a home builder. He's building 2 just on the street in behind me. And it took him longer to get started, and it's taking him longer to complete it because he can't line up the people to get it done. No construction company can hire fast enough, so they start stealing from each other and paying higher and higher prices. Why do you think housing prices keep going up, right? Because you got to keep paying more and more and more just to get it done, just to meet, there is demand out there. It's not the highest demand it's ever been. but we have a lack of supply. This is a problem. I think that this number here, this 2K, is a limitation of the supply of labor, not so much a sign of the ability of the economy to create jobs. That's why you have 11.5 million job openings and only 5.9 million people. There's basically 2 jobs for every person. If you're one of these 5.9, either you have absolutely no marketable skill whatsoever, or you're simply not trying, because there are 2 open jobs for every single one of you at wages that just have strong wage growth. So, why the labor force is not expanding, or the participation rate is not increasing, is curious. That's why we have this big question mark over here, that your costs are going up, but output isn't. Now, this is the other curious thing here that we don't really have an answer to, because in Q1 GDP we saw the consumer contributed to real GDP, which means positive output. So is this output down 2.4% because you simply can't get the stuff to make the stuff to create the output? Or is it down 2.4% because nobody's buying the stuff? All the car companies have reported, and all of them say the same thing. All of them have said the same thing. Our sales are where they are because we can't make enough cars. It's not because we can't find enough customers, it's because we can't make enough cars. So you have GM, Ford, reporting that their output is down year over year, quarter over quarter, and every month when they report we see that it's down over last year. Not because they aren't doing their job. They are doing their job with limited supply. They can't get the supply they need to create the output. So is this a sign that demand is sick, or is it a sign that supply is still sick? Don't know. There's just so much uncertainty. A lot of evidence suggests that it's supply related. And a lot of evidence suggests that the inflation that we're seeing is supply related. And you're thinking, how can you possibly say that? Let's go, I'm going to do a timeline right here. And let's go back to 2008. And we'll go all the way to 2020. 2020 is when the pandemic hit. And inflation from after the financial crisis was way lower. I'm going to draw a line like this, was way lower than where the Fed wanted to see it. But the Fed's balance sheet did this over that period of time. And then the pandemic hit, the Fed's balance sheet did this. However, the pandemic created supply disruptions. The great financial crisis created no supply disruptions. And we couldn't get inflation up. The central bank kept saying inflation is low. It doesn't warrant a higher rate. All the time, the money supply kept expanding throughout that. We didn't see inflation because we didn't get any supply bottlenecks. But now we do. Now suddenly we have supply bottlenecks, and it's not hard to make the story that there are supply bottlenecks. You had 2 exogenous events. You had a pandemic which shut down everything. Well, we learned that you can't just restart as quickly as you shut down. You have a war, which disrupted a lot of supply coming out of Europe, which just added to the problem. And you have continual lockdowns in China, which just exacerbate the problem even more. So, and in the US, by the way, you have a shortage of truckers. So you get the stuff in the ports, you get the containers off the ship onto the docks. Where are the truck drivers? You have a shortage of truck drivers to actually drive those trucks to where they drive those containers to where they need to be. So is this telling us that, yeah, supply is the big problem and you're facing a significant policy mistake by raising interest rates because you're not going to fix anything? Or is this saying, hey, listen, demand is the problem and these rising interest rates are actually working on demand, and this low level here for construction is because nobody wants to buy houses at these high prices. It's not that supply is low right now. It's supply is low, but guess what? So is demand. Here's the thing. I don't know what the actual answer to that is. Uncertainty is high, and when uncertainty is high, what is high? risk. The price of risk is high. All right, here is the first of the sites we'll look at. This is the jobs report itself. You can see up in the top corner here, 40 pages. And it starts with the household survey data, and then it introduces the establishment survey data. So it measures job creation two different ways with two different samples. And if you want to know why, you go down to the notes. It'll explain why they do it. They both have their pluses and minuses, so they combine the two. Then it has a whole bunch of tables in terms of how they break it down. The employment rate, total 16 years and over. Here's adult men 20 and over, and the 16 to 19. They break it down by race as well. Reason for unemployment, duration of unemployment. So there's a lot of interesting stuff that you can look at here if this is what you're interested in. Here it is right here. Why are there 2 monthly measures of employment? So they give you a brief description, and a bunch of other questions that are worth reading so that you know when you get this number, you have a lot more insight into what's behind it. Some technical notes if you want that, and if you keep on going, you will start to hit all of the subtables, household data. So they'll go through all the household data, then they'll go through all the establishment data. So there's a table for everything. You can see it's broken down in years, in genders, in race by years and genders. There's white, Asian, black, Hispanic as well. It's just lots of good information. Over here, we have labor force statistics. This is broken down a little bit more. 16 to 19, you have the 16 to 17, 18 to 19, 20 years and older. So it gives you 20 to 24, and the 25 years and older, and it breaks it down 25 to 34, 35 to 44, 45 to 54. And it gives you the participation rate over here, and you can really see once you get to the 25 to 54, you're 82. Almost every decade in there. The 25 to 34 is 83. The 35 to 44, 83. The 45 to 54 is 80. And then this is 55 and older. Drops right down to 38.7. And we can see 16 to 19 is 36.6. With the 20 to 24 being 70.4. So big jump once you hit 20. You start saying, well, you know, this is something I should do is actually get a job and not live at home. But those that are 20 to 24 are actually lower than where they've been for quite some time. So there's lots of data here. I've got this site listed as well. If we look at Fred, there's labor force participation, 55 years and older. It really hollowed out from the 70s right down into the 90s, but then started to increase. This is interesting. I don't have a good story for this. So if anybody has any research or something that points to what was going on here for 55 and older, I'd like to see that. This is 25 to 54. You could see that it's economic reality, right? It's fairly elevated, and we're almost right back where we were. 82.5. Pre-pandemic was 83.1, and this is 20 to 24, and it has been dropping since 2000. It has been dropping consistently. And we're sitting now at 70.4. Back in the 80s, you're up to almost 80%. It's now 70%. What's going on? I think some of this might be the 20 to 24 age group here. In the 80s, it wasn't such a big push. Oh, you got to go to school. You got to go to school. You either knew you were or you weren't. It wasn't really a big thing. Now it is. It's like you got to go to school. So it could be, this just could be a remnant of that pressure of saying, you know, look, you're not going to get by with a high school education. You need at least a BA just to get a job on a factory floor at Starbucks these days. You know, everybody's got a history degree or a poli-sci degree there. So that could be showing up in here. I don't know. And finally, productivity cost first quarter. This is also U.S. Bureau of Labor Statistics. And you can dive a little bit deeper into their analysis here. And then they've got tables of, where things are now versus previous periods. lots of data there if you want to look at it. So I leave those links to you for those of you who want to dive a little bit deeper. Also, during the past week, ISM reported. ISM is the Institute for Supply Management. So this is, if we think that there's something with supply, well, we want to pay attention to these reports, Institute of Supply Management. Now, you can view the report. I'm not going to click on View Report. I'm just showing you where the site is. They're really, really particular about any of their stuff showing up anywhere, that if you're going to, and it says recreate, distribute, any of that stuff, you got to ask for permission. So even me sticking it in a video might get them a little upset. I don't know. I mean, it's a publicly facing website. If I put it in a video, I don't think it's a big deal. But after I read their terms and conditions, I thought, maybe I won't use any of their data. Then I'll just show you the site. So PMI, manufacturing PMI, and for services as well. These are diffusion indexes. So they're made up of sub-indexes, and it's the sub-indexes that are important to pay attention to. New orders, prices paid, things like that. So have a look at that. We got the manufacturing PMI data this past week, came in lighter than expected, but still showing growth. Anything over 50 is showing growth. Still showing growth, although slower growth. So growth is slowing. But it is worth diving into and reading some of the analysis they have on the sub-indexes. And you can see the full report here. I will leave this link in the description box as usual, and you can, depending on what part of the economy you're interested in, you can dive a little bit deeper. All right, this coming week we get another look at CPI. We've already seen the used car index sort of turning over. These are 6-month charts. Nickel here is a 3-year chart. Here is copper. You can really see it coming down in the last couple of weeks. Aluminum, you can really see it coming down. This was the Ukraine invasion high. You can really see aluminum coming down. Unfortunately, the traded contract for aluminum isn't that liquid, so you don't have a very good data series, and all these points are just marked prices, not actually, they're just closing prices based on where the spot closed. You can calculate a forward price, and that's it. Here is palladium. You can really see this coming off. It was in the $3,000 range for a while. We're threatening to break down under 2,000. Copper, if you look at a 6-month chart on copper, it is bouncing off a 6-month low. So is this just a relaxation of all of the panic we had up here, saying, oh my God, we're simply not going to have enough supply? Is this a symptom of the lockdowns in China crimping demand? Or is this just a trend of downward prices because prices were so high, a lot of supply had come online? Here is nickel. Nickel is still elevated. I mean, if we look at a longer term chart for nickel, it's still elevated, but is coming down. It is going to be interesting to see what happens in terms of copper, because the move to EV requires a lot more copper in the vehicle in the years to come, and especially with things like nickel, cobalt, lithium. I read somewhere, and I hate saying things like that. I read somewhere. I heard, I saw somewhere. So take my word for it. But I didn't read it. I heard it. It was on CNBC. I did hear it. Somebody was talking about the projection for car batteries by 2030. That there'll be 10 times more in terms of volume produced. But there isn't enough right now. Currently, there is not enough nickel, cobalt, and lithium being mined to meet that projection, and that his conclusion was that 90% of the supply channel doesn't even exist yet. So I don't know that you're going to get it there. So it could be that these are more temporary, and these represent what's going on with lockdowns and the drop in demand than any long-term trend in these prices. But that should, all of these lower prices should be interesting for what we will see on CPI this coming week. Okay, let's take a deeper look at WTI. And I had already had this chart up in weeks past. This is miles driven in the US. This is not seasonally adjusted. And when we're looking at miles driven, we don't want it to be seasonally adjusted. We want the raw mileage that is actually happening. All these peaks are Julys. This one here just happens to be in August. And all these low points are February's. You can really see the seasonality in driving. This was February over here. If we look at the trend, if we just draw a straight trend line, we can see where the trend is going. So where do you think we're going to end up by the time we get to July and August this year? It is seasonal. And we've had high oil prices before, and miles driven still showed this seasonality. If you go back to 2005, 2006, 2007, gas prices in the US were still $4 a gallon, still had this seasonal pattern to it, that people, when it comes to the summer, more miles are driven. So this speaks to increased domestic gasoline demand going forward. Here is the USO chart that I put up last week. I demonstrated that we had a continuation pattern. It is a pennant flag formation, what's called a symmetrical triangle, as opposed to a right pennant, which just looks like this, or a descending pennant, which would just look like that. It's called a continuation pattern because this is a consolidation period. You have a fight between the bulls and bears about which way the price wants to go, and these things tend to break out in the same direction that caused them. And looks like you got a breakout in the far end of the chart over here. The IEA is forecasting demand for 2022 at 99.4 million barrels per day, and forecasting supply for 2022 at 99.1 million barrels per day. There's a shortage of 300,000 barrels a day, and combine that with global inventories have been down for 14 straight months. The level of inventories have been dropping for 14 straight months, and we're about to go into a gasoline demand season, the busy driving season. And this pattern has been absolutely consistent since this chart has begun. This seasonal pattern. WTI is West Texas Intermediate. It is a U.S. blend. It is going to respond more to domestic conditions. We'll look at, or actually we looked at the supply last week, the inventories, and we saw that the current level of inventories for WTI are even below the 5-year average, and the average is a range from the highest to the lowest of what it would range within, and it's below the lowest at this point in time. So you have very low inventories. You have a driving season coming up. You have a market that is not completely supplied. You may say, well, it's kind of in balance, but it's not completely supplied. You have global oil inventories that have been dropping for some period of time. And you have a chart pattern that is sort of confirming all of that fundamental stuff as well. So the technical stuff is confirming the fundamental stuff. Also, the Biden administration, I think, has put out an RFP, a request for, or RFQ, a request for a quote, to replenish the strategic petroleum reserves, of which they've drawn down. So if they're going to rebuy all the oil that they've released and refill that up, they're going to be competing with the summer drivers for the source of that supply. Now, layer on top of that an industry that is not going to spend a lot of money looking for greenfield sites. You have auto companies all around the world that have announced up to 2025, mind you, this is just to 2025, $500 billion of investment in EV. You have battery plants being built all over the place. Oil has limited, I shouldn't say limited life, limited growth at this point. In fact, over the next 15 years, probably negative growth. So I don't know any oil company that would be spending huge amounts of CapEx to increase their reserves. I think at this point it's like, look, this is a harvest situation for the next 20 years. We got some majors have like 100 years of oil reserves. It's like, well, let's harvest, which means this is not supply management in terms of building our reserves. This is supply management in terms of the speed at which we deplete our reserves. I think that'll be the bigger thing. So I would not expect the oil industry to start spending billions of dollars looking for new sites and building new wells and new facilities that take 7 years to come online. And we can see that with the last IEA report. The level of CapEx is not increasing. Price of oil is going up. Level of CapEx is not increasing. The number of drilling wells really isn't increasing that much. No one's in a rush to oversupply this market, because for the last decade they've been called dirty names. They've been called all sorts of names. And now that there's a crisis, we want them to help us. And then after it's gone, we're going to go back to calling them names. And we're blatantly telling them we're spending money on infrastructure specifically to obsolete you. Yeah, I don't see a bear market in oil anytime soon. Let's take a deeper look at USO. Okay, let's see if we can't set up what looks like potentially an interesting trade, lower risk trade. I don't know that I would be going long the USO as much as trying to buy some of the upside distribution. As I don't necessarily need 50% of the upside distribution, but when you buy the underlying ETF, yeah, you get all the upside distribution, but you also get all the downside distribution. We just would like to get some part of the upside distribution without the downside. What we have here is we have a pattern breakout as witnessed over here. However, we have near-term resistance. So while we have a pattern breakout, we do look like we have a double top going on here, maybe a triple if you want to count this one as well. And the saying is there are no triple tops, so maybe this just keeps going, and then you have the high that was set a while back with on the invasion of Ukraine. Longer term, I've drawn this line over here. This would be a much longer term. You'd have to get through a bunch of support lines as well, but you got big support down here, just a little under $60. So we're going to use that as a way to offset some of the trades here. So let's look at two bull spreads, the 85 to 90 and the 85 to 95. We're sitting at 82.05 right now. You can bring your bull spread down, but I'm going out to June. As you start going out further months, you don't have the discrimination in the price points like 82.50 to 87.50 that you would have on the front month. So you try to find numbers that'll work. Going out to June, because July is the peak, July, August is the peak in driving season, so I want to get as close to that as possible without getting in July and August where the market is already anticipating the September, October, November decline in driving, and the price is already reflecting that. June is still far enough away that you haven't hit the peak in driving that it may get through these numbers. 85 to 90 bull spread. Cost $1.62, pays $5. It's a $5 spread. The 85 to 95 costs $2.65, pays $10, which is not bad. Margin impact is zero. When I say zero, it means beyond what you pay here, that's it. And now if this reverses and just crashes, that's it. That's all you risk. $162 to pay $500, or $265 to pay $1,000. That is the most you risk. And if it does break through and starts dropping, it's not like this will go to zero. You can get some residual value by getting out. So to me, that seems like the low risk way of playing a breakout, a potential breakout, going into a busy driving season, the summer driving season, with low inventories and almost an unwillingness for new CapEx. For the 85.90, if you add a 71 put, you can get that cost down to zero, because the 71 put's about 62. So you'd be sitting right there on the 71 put. So if you think about it technically, maybe that is near-term support. For the 85.95, you add a 75 put, you get a zero cost. But you do have margin impact, because now you're short a put, right? Your margin impact here would be 14.63. and now these are all in US dollars because the USO is in US dollars as well. Your margin impact would be 1463. For the 75 put, your margin impact is 1833. So that means you're going to need not only, well, it wouldn't cost you anything if you had the 75 put. You're not going to put out the 265, but you're going to need 1833 US in your account. And you have all the downside risk of the distribution below 75. Here you got all the downside risk below 71. For either one of these two, you can add a 60 put, which is right here. It's the kind of like the longer term support. I don't see WTI dropping to $60 by June unless you have another major exogenous event that happens, like a complete China shutdown for an extended period of time, or Russia deciding to go nuclear, right? 32 cents. You can offset the cost of this by 32 bucks. Adds 500 US to a margin impact. So you'd lower this 32 bucks, but you still need another 500 in your account. For 32 bucks, you know, I'm perfectly willing to pay 162 that pays 5. I don't know that I'd be too interested to get that down to 130 to pay 5. Even 265 that pays 1,000, that's a nice margin. I don't know that I'd be that interested in chopping off 32 bucks off that cost. I don't know that it's significant enough. But if you believe that, well, this is not going to happen and I got this anyways, then it's just, well, why not? You're leaving 32 bucks on the table by not doing it. To me, these are interesting plays on the USO because there is still one big looming question. Yes, there is an issue with supply right now, but demand is the other big issue. You know, as prices keep going up and up and up, is demand actually going to show up? Now, the history of driving season shows us that, yeah, it does. It still does in the summer. It still goes up. But what happens if you have, you know, major shutdowns in China that continue, that really lower demand for oil? Well, that'll lower the global oil price, and you know, WTI will go down along with it. So that's why I think that, hey, listen, I don't mind betting 265 bucks and losing it, you know, as opposed to buying a futures contract of oil. By the way, the futures contract of oil, because of the higher margin requirements, one contract is going to cost you $27,000 in margin. And every $1 move is plus or minus $1,000 versus 265 bucks to play along, which has a nice ROI, a very nice ROI. I mean, if you buy oil and you say, I'm going to put a $1 stop on it, you're more than likely going to get stopped out and you're just going to give away $1,000. If you're going to do that, take 3 bull spreads, right? There's your, you know, that's, you'd lose less than $1,000 if you lost it all. And it would take more than just a $1 move in oil to lose it. And you have the potential to pay $3,000, the payoff of $3,000. Okay, this week in earnings, 2022 Q1 year-over-year earnings. Expected to be up 10.4%, excluding the energy sector, 4.3%. Nice and robust. 434 companies have reported. 79% have reported earnings above analyst expectations. And for revenues, 74.8 have reported revenues above analyst expectations. And there are, well, there was about 71 companies left to report. We'll look at who's reporting this week. The forward 4-quarter PE is 17.7, but that's based on the opening price on Friday. Friday wasn't that bad. I think it was down 23 points, but we'll calculate forward PEs based on the closing price. Look at this, right? This is earnings revisions. And last week we're at this point. We're even higher now. So earnings are showing up. Nothing wrong with earnings here. This is the quarter that was. You know, so, you know, is it going to be the quarter coming up? Always something to look at, eh? Always something to look forward to. Up 7.3%, the surprise. Let's see, I can't just highlight that one. Up 7.3% for the S&P 500 over what was forecast. If we scroll down, we will find our forward multiples here. This was the opening price. The closing was 41.23, so it's not that far off. Trailing EPS 227.50, forward 4 quarters 234, and for 2023 250. So the market currently right now is trading at 16.6 times forward earnings for 2023. That doesn't mean it can't get cheaper. I mean, it could go to 15, it could go to 14. It depends on the sentiment. Really, a lot about the real rates. If we see real rates continue to increase, especially high growth and growth in general will be under pressure. So doesn't mean we can't go lower. I think if you're looking at the market and you're finding those stocks that have PEs under 10, under 7, under 6, I don't know that there's too much bearishness that you're going to get on that. But when you start looking for those stocks that are still trading at 50, 60, 70, 80, or in Tesla's case, 140 times forward earnings, yeah, I think there's a lot that could come out there. And some of the other more speculative asset classes that have appeared, crypto, NFTs. I honestly still don't get NFTs. I just don't get that whole NFT thing and why some of them are $500,000. And I think, but why? What have you got? I think it's there just because, look, there's nothing else. There's really nothing else. There's no yield anywhere. So let's create something, see if there's something there. I could be way off base. I don't know. I myself don't get it. I'm not alone on that. I listen to some of the analysts on Bloomberg. There are few that are crypto bulls, but most of them are in the same camp I am. Is like where's this possibly going to go? Let's look at who's reporting for the week coming up. There are some important names to look over. Duke Energy, Tyson Foods is a fairly big one. If you're in the REIT space, Simon Property Group is another big one to watch. What do we have on Tuesday that's interesting to look at? Occidental Petroleum will be interesting. Wynn Resorts, let's see what's going on in Las Vegas. All right, Walt Disney. Let's see what Walt Disney is going to do based on what Netflix is. We've seen Netflix. Are we going to have a repeat with Disney, or is Disney going to, be surprising? Estimate $1.19 versus a year ago 79 cents. You missed that $1.19. This market is not in the mood to forgive anything anymore. But this is Wednesday. They're reporting after the close, so a lot of the sentiment for their earnings, I think, will be weighted heavily by how CPI performed. And Thursday, that's the end of this one. Nothing interesting to look at. This used to be a thing, but 2004, 2005, you'd look at it. Now it's there it is, right? And nothing on Friday. Okay, so let's look at some levels if we want to set up some trades, and I'll give you an interesting one if you are very bearish on the index. Closed at 41.23 next 12 months. Earnings 234.44. So here are levels 15 times 16, 17. Here's where we are now. There's 18 and 19. I don't see in the near term any elevation above 19. I don't even know that we get back to 19. And if we do have any kind of rally, I think that would be a point 445 on the SPY, where I would be, thinking about very significant short positions on that index, or selling calls. That would be my first step. I'd be selling 445 calls as we started to approach 445. 42.19 I think will be tough as well. That is 18 times. We're at 17.6. 17 times is 39.85, which isn't that far down. You could think of one bad day. You get a bad CPI print. You sell off 100 points in one day. You're sitting just above the 17 times forward earnings. That's at 39.85. 16 is at 37.51, and 15 at 35.16. And I've heard some commentators, some analysts say that we could see 38 and maybe even down to 34. When I hear numbers like 34, I think, well, why 34? What's so special about 34? what's going on there. And maybe they're seeing something technical. I prefer to see it in more of a fundamental way in terms of valuations in multiples. The long-term average, forward average for the S&P is 15.5. I just don't know that makes a lot of sense given the mix in the index today. I don't know that you can take a long-term forward PE. I think, if you're looking at a 15 or 10-year forward PE, probably the 10-year to me would seem a little bit more relevant as the first valuation, forward valuation as an average that I would use. That's sitting somewhere around 17, which is over here. But if you think that no, the last 10 years are not representative of the long term, because the last 10 years were met with unprecedented low rates that we've never seen before in balance sheet expansion. But as I said when we talked about rates from 2008 to 2020, we had low rates and balance sheet expansion, and you couldn't get inflation. I'll show you the index, the same chart in a 5-year and a 10-year, and we'll look at some growth rates that if we followed a particular growth rate, where would the index be in the absence? It's the best way we can figure out in the absence of all of this stuff, and we just had the past, if those 10 years were like the 10 years before in terms of policy, where would we be? So in thinking about where we could go, the negativity is running high, and the big word is stagflation. That's what caused Thursday. Thursday's big sell-off is the fear of that happening. So unless we get data that turns that around, it could get more negative. So that CPI number next week is going to be important. If it moderates, if we see that it comes down yet again, then I think you could have a rally for the rest of that day. If not, if it comes in yet even higher, then you're going to hear, there's going to be an inter-meeting rate hike of 50 basis points. No, the next meeting is going to be 75, and the conversation may even turn to 100 basis points, and they're going to have to accelerate the balance sheet runoff, and that kind of talk will start, and the central bankers will do their tour, and they'll start talking freely as well. So a lot hinges on that in terms of we've got the stag and the inflation, right? I don't know so much that we have demand-driven stag as much as supply-driven stag on the output side, and what's driving the inflation here. If we can see it moderate because some supply is coming back online, then this word might fade into the background again. If we're interested in just putting up a nice, safe trade that is bearish without shorting the market, because these kind of rallies, especially in corrections and bear markets, these rallies are sharp and hard because you got buying along with short covering, so they can really hurt you. So I don't know that you want to be short the market. Again, there's a distribution of returns, right? If I draw a normal distribution across here, you have a potential distribution of returns. We don't want this part of the distribution. We'd like to get some access to this part of the distribution without having to short, and options allow us to do that. Because we have a lot of skew on the index right now, bear spreads are cheap because we're buying a put here and we're selling a put up here. Well, look at the implied volatility is significantly higher, so you're letting the implied volatility help finance the cost of your bear put. Your bear spread with puts. Rather than picking prices at random, do a 400 to 380 bear spread, I just chose levels 17 times forward earnings to 16 and do a spread between those. That's a 398 to 375. The way it works out for June, because these are June prices, is you couldn't quite get the same strikes, but you had a 24-point difference between them. 548. So you spend $548, and if the market through June does go down, if CPI is ugly, you do have one Fed meeting coming up in June, you could get you could get new lows. You could trade down to the 16 times forward earnings level. 548 pays 2,400 if it's right. Implied volatility, 52 weeks is 94, 26 is 88, 13 is 77. Would have liked to have seen that higher. If this were higher, this would have been cheaper. Maybe 20, 30 cents cheaper, but if this were in the 90s, it would have been cheaper because we would have had, with higher implied volatility, you end up getting higher skew as well. But we are elevated. We're over here. So if you draw a line this way, you see there's been only a few times where it has been higher. Most of the time we've been below that line. Let's look at some growth trajectories. That might give us some idea of, well, are we really that far off? We're at 41.23. 41.23, and we're saying, well, it was all of the balance sheet expansion, especially during the pandemic, that really inflated the market. So it's really got to come down to pre-pandemic levels. Is that true? Let's find out. Okay, we're going to use a 5-year and a 10-year. And then, it's up to you to determine what seems reasonable to you or where you feel most comfortable. So I took the same starting point at the level of the index here, and I grew it at a compound rate, 9% here, 10% here, and 11% here. If we say, well, over the last 5 years, a more reasonable growth rate on the market would have been 9% per year. We would be today at 36.86. If we thought 10% was more reasonable, would be at 38.51, which is right between the 16 and 17 times earnings. That's about 16 and a half times earnings. And if we went to 11%, would be at 40.30. Which is only 90 points on the index below where we are now. The long-term average is 10.5%. Now, I'm going to use a 5 and a 10. The question is, well, could you use a 20? I could use a 20, but the 20, the long-term average on the 20-year is 7.58%. That's really low. Why is that low? Because you have the big sell-off 2008, 2009 in there where money, by the time you got to the bottom, money was dead from like 1999 all the way to there was dead money, where you were right back at the same level. So growth really didn't start till the low point of that drawdown. So I just thought, well, let's just leave it at 10 years, 5 years, and 10 years. So 10 and a half gets us somewhere around 39.40, just a little under 4,000. 39.85 is 17 times earnings. This is very close to 17 times forward earnings, which has been the last 5 year or the average forward PE for the last 5 years. So if we look at the 10%, anything above the line, the 10% should be the mean reverting line. So we're above it, we're slightly below it, above it, we're below it, it comes back up. Notice that it kind of works out kind of nicely. You have a top right at the 10%, a top right, then it breaks above it, we're above it. This here, again, I say you can typically ignore that kind of stuff. So we got back to it fairly quickly. And we kind of hang out in that range for a while until it just decides, nope, off we go. We're just going to accelerate. And off we went, and then now we're questioning it. So yeah, if we look at these lines, these levels here are way above any of these lines. Even if we take 10 and a half, would be in here. We're way above. And the long-term growth trend is typically the mean reverting level. Otherwise, it wouldn't be the long-term growth trend if it wasn't. So we are a little off from that because this is the period we're looking at. Let's see if it changes if we incorporate 10 years. So if you think the last 5 years is not going to be representative, we can go back a little bit longer, take 10 years. I use a common starting point here and I grow it at 4 different rates, 8%, 9%, 10%, and 11. And here are the different levels. 8% would have gotten us to 29.18 We're a long way above 29.18. But I think 8%, considering that the long run average is 10.5, 8%, in the absence of all the central bank intervention, I think 8% still would have been too low. 8% sort of seemed, if you look at the bottom line, we were way above 8% the whole time. In fact, 8% seemed to be the buying level at every point along the way. 9% would get us to 3,200, a pullback to 32 if we accept that 9% would have been the right growth number. 10% is 35.06 and 11% is 38.38. On the previous screen, 11%, if we just use the last 5 years, was 40.30. This is 38.38, a good 5% below it. So if we take the long run average of 10.5%, and 10.5% would be somewhere within here, that's 11% down from where we happen to be right now, versus 10.5%. Using a 5-year would get us to 39.40. This would bring us down to 36.68. So the 17 times to 16 times bear spread that I mentioned earlier, depending on which one you think, might not be bad to put on as a hedge against long positions, so that you can have long positions and say, well, I feel good about my long positions because my protection is not going to cost me a lot, and if it gets there, then great. The best long positions, I think, right now are low multiple stocks, carrying low multiple stocks that have a dividend yield. No, they're not going to go up when the market goes down. Nothing really goes up. Even good stuff goes down. But there is a difference between being in ABC and saying my stock is going down, the price is going down because ABC is going down, and saying ABC is going down because the market is going down. If ABC is going down because the market is going down, stay put. You're doing good. You're just suffering the market risk that every stock suffers. But if ABC is going down because ABC is going down, then reevaluate. But if your holdings are going down just because the market is going down, you hear the expression, what goes up must come down. Well, what comes down must go up. Look at the long-term history of the market. It always goes up. You'll have periods of time where it does this, where it does go down. But this is climate, and this is weather. Weather can do all sorts of things, but climate is a long-term trend. When we do not say that we need to decarbonize to fight weather. We're not fighting weather change. We're fighting climate change. Climate is the long-term trend. Weather can do all sorts of things in between, right? So there you go. Okay, for the Barron's story, if you Google Barron's future of EVs, I can't actually show you the Barron's story because it's behind a paywall. I can't show it to you. But what I can do is they release parts of it online. Here's the future of transportation is a lot more than Tesla, and there's a whole bunch of parts to it. Toyota's trying to catch up. Will Americans buy millions of Teslas and other EVs? Tesla's winning. Better batteries will help Ford. Electric cars mean automakers can design the future. EVs are now better than gas-powered cars. GM stock is a buy. Finally, somebody else recognizes what I recognize, right? Though the company must do more. I agree with that. Number one, you got to change that CEO. You got to get rid of that CEO. You need a new one in. Couple of blunders there. GM is spending billions. What it means for Tesla stock. Tesla owners worry about winter. The EV industry is working. There's a whole bunch more on this one as well. And as I was going through all of it, as I've announced before, I do have a video coming up about the auto industry and what I would say is the impossibility of all of these targets being met. That ICE is going to be with us for quite some time, but it's being thrown out and it's not going away. It's not going away. And some of the stories in this article get to the same conclusion as well, and it doesn't take much searching on well-respected auto analyst sites to come to the same conclusion that if everybody tried to hit their target for what they've announced, there simply isn't the supply chain to get it done. It's not going to happen. And these aggressive targets that countries have hit of 2030, 2035, 2040 of being no more new internal combustion is probably going to get pushed back again and again. So if you're interested in doing some reading, there's a whole bunch of interesting stuff on this one here. So I leave that to you. Let's have a look at our economic calendar for the week coming up so we can see where risk lies and what time risk is going to show up. And for the week coming up, it's heavy on monetary policy because we're going to get a read on CPI, which is going to be looked at very carefully. And you have a lot of Fed speak all over the calendar. So let's have a look. We have Bostic at one evening, followed by the next morning, then wholesale inventories. I don't know that this is going to be that important. It's hard to get a read on wholesale inventories because you have back orders. So as fast as things are made, they don't always have a chance to end up with a build in inventory before they get pushed through. So I don't know that we're going to get too much excitement out of wholesale inventories. What we don't want to see is that they are down significantly. That's not good either way. Consumer inflation expectations. This is for April. By the way, that is for March. It's kind of backwards looking. Consumer inflation expectations. This has got a low level of priority. I think that could be elevated to medium because consumers are workers. And if consumers have inflation expectations, workers have wage expectations. So if they expect inflation to be high for a period of time, when they get their 5% annual raise each year, they're going to say, look, come on, man, inflation is 8%, you're giving me 5%. That means I have less purchasing power. You got to give me more than 8% just so that I can keep up with inflation. If you give me 8%, you haven't given me a raise. You haven't given me any kind of real raise. So I do think that this should be elevated because consumer inflation expectations are going to lead to wage expectations. And if businesses are expecting wage expectations to be elevated, they will then increase their prices in front of those wage increases, thereby creating the very inflation of which they've got to pay for. What else do we have? Williams, Bostic, Kashkari, Waller, Mester, Bostic. I told you, there's a lot. This, depending on what these people say, the market is going to be listening. The market's going to be listening for any kind of clue that Powell was a little too light on what he said, that in fact it's going to be a lot more hawkish. Mortgage applications, I think they're interesting to watch. We had 2.5, which we saw last time. Let's see if it can follow through. Mortgage, 30-year mortgage at 5.64. I don't know. That's what the May 6th one will reflect. Will reflect the rates that happened during the course of the week. So let's see. This is it right here. Wednesday, 8:30, core inflation. This is going to be the big number. Previous was 6.5. Look at that forecast. For core, down to 6. Previous 6.5, down to 6. Expecting it to moderate down to 6. So we'll see if that actually happens. Month on month, 0.2, right? Last was 1.2. This is not core. This is the inflation rate itself, 0.2. If core comes in lower than that 0.4, that could be very good. Then if you're watching oil, 10:30 is when the inventory report is released for the U.S. for Cushing, Oklahoma. You have your inventory reports. This does move the oil market and gasoline, heating oil. Bostic, monthly budget statement. I don't know what to make of this one. This is this to me is kind of a curiosity. You did have the Biden administration last week sometime suggest that it doesn't make sense to run budget deficits when inflation is this high, which I thought, well, that's a responsible statement to make, because last week I said what pisses me off is governments feeling they can run deficit after deficit with inflation this high, but putting consumers in the position where no, you cut back, not us. So by making that statement, I thought, well, that's a pretty good statement. 220, that is a surplus. PPI, this is a producer price index, kind of a measure of what producers are feeling and kind of a leading indicator of what may be passed on in the final price, which would then show up in CPI. Continuing jobless claims, initial jobless claims, they simply just don't move the market anymore. Let's keep going here. What else do we have? Daily. Michigan consumer sentiment. We'll see where that ends up. It's expected to drop even more. And then Kashkari. Also, this is interesting too, and they have a nice app. You can download their app, the Baker Hughes oil rig count. This comes out at 1 o'clock on Friday. Previous was 557. We can sort of just drop it down, and we can see rigs. The rig count is increasing, meaning that more rigs are being put to work to get oil out of the ground, meaning that oil supply is increasing as well. But while it looks, wow, look at this go. Let's keep in mind 548 to 549 over this week. One came online, then 549 to 552, just three more, and here 552 to 557 for the whole for all the regions. Only 5 more came on. If you go back to pre-2008 and you look at the rig count back then, starkly different than what it is today. You have oil prices that are pushing. While they've been around the $100 barrel for a while, and these rig counts, okay, let's add one more. So when you look at some oil fields and you think, okay, there's one more going on, there's another one. It's like, that's it, just one more? There is a real hesitancy to make the mistake of 2014, 2015, which is to keep investing and keep pumping and completely oversupply the market and destroy your own business. There is a significant hesitancy to doing that this time. So there is the economic calendar, and I've got somebody that I'd like you to meet. This is Pete. He's my new friend. He's 12 weeks old. I just got him yesterday. He's not house trained yet, so he's dropped a few loads on the floor. But I got hardwood floor, so that's pretty good. But he's been looking, at what I've been doing here. He's kind of interested all day long. He's kind of having a look at the screen right now because there's a really nice chart up on the screen. But this is Pete. Say hi to Pete.